When the market is crashing, people lose their minds. Fear makes them react irrationally. And if you want visual proof of that, just pull up a chart of the S&P 500 for the last 10 years. And there's great proof if you look around March, April of 2020. And if you go out 20 years, you'll see some other examples. Say, geez, why was there that V-shaped bottom there? And just look at what was going on in the news then and say, oh, yeah, boy, the market really overreacted there, didn't they? It happens. Can't say all the time because it's not like every month, but it happens regularly and is going to continue happening regularly. That's just how the market works.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 60, Fear and Loathing in the Stock Market. But before we jump in today, I had many of you contact me with questions about my upcoming book, Build Consistent Wealth with Options. To get updates on the release schedule and to get pre-launch bonuses, excerpts of the book, and more, go to bcwwo.com. That's bcwwo.com, as in the initials of the title of the book, Build Consistent Wealth with Options, and get on the list. Traders use options for different purposes. Debit spreads, credit spreads, straddles, strangles, you name it. For any thesis you might have for what the stock might do in the future, there's an option strategy that helps you capitalize on it. Still, most option traders use options to get more upside exposure, meaning to make more if the stock market goes up than just what the stocks in their IRAs would earn them. They buy calls. Strangely, that's still the most popular option strategy, which I guess is because it's the easiest to figure out how to do. Though maybe not the easiest to make money consistently with, but they also sell put credit spreads. They sell cash secured puts that are really just naked puts, but they happen to have cash in their account. They say, oh, I'm okay getting assigned, but man, if they do, they will have a seriously adrenaline rush, and not the good kind. Those damn Wall Street traders, how could they do this to me? Somebody pass a law. I shouldn't have had this happen to me. Behind the seemingly nonchalant trader leveraging up, there's great fear. When we get pullbacks or corrections or even bear markets, investors often ask me, Dan, how are you handling this? And I usually meet their sense of urgency with a very contrasting calm and say something like, hey man, I'm loving it. I'm taking advantage of this high volatility and selling way overpriced puts. And maybe they ask something like, yeah, but what if you get assigned? Well, that's what I'm hoping for. Look, level-headed long-term investors generally love overreactions in pullbacks. Those opportunities to buy stocks under intrinsic value, to buy them at fire sale single-digit PE ratios, to take advantage of a temporary problem, to achieve a long-term solution. If stocks were always traded with perfect logic, without emotional reactions, if they always priced companies for what they were actually worth at that very moment in time, well, there'd be no point in trading. It's the job of every trader and every investor to find mispricings and overreactions or underreactions, to find situations where they can buy something that is temporarily too cheap, but no one seems to care. They're too busy being scared. And smart investors take advantage of those situations. Every decade or so, all heck breaks loose. In the year 2020, well, we had the COVID crisis. And before that, we had the global financial crisis of 2008. We had the dot-com bubble's 80% market drop, or slide, I should say, which happened from 2000 to the year 2002. Kind of seems like you can count on these things that you can't count on like clockwork. When these extreme market drops hit rock bottom, we call that capitulation. Capitulation means what? Well, for those of you who study history and learn about battles, when the army capitulates, they give up, right? That's what it means. It means to give up, to quit. And like I said, these are situations that you can take advantage of. When markets start falling in these situations and it becomes clear that, oh gosh, it looks like this is really going to keep going, this is no regular buy the dip scenario, a lot of investors just get really scared and they sell their stocks. Now, there are some investors who hold out during that period. And then if it keeps going lower, what happens? Well, more fear comes into the market. And then some more of those investors who are left, well, that's when they sell. And then it happens again. The market goes down more and still more sell their stocks. And fewer are left holding their stocks. And the free fall continues. And sometimes really rapidly, and we can all see how people get scared. We've all felt the fear. And after a just relentless downward move, the investors still holding out, a lot of them reach what a guy that I used to trade with down in the pits on the CBOE trading floor used to call the stomach turning point. And they just can't take it anymore. And they give up. The last holdouts, they give up. They capitulate. This is the final wave of selling. At that point, there's nobody left to sell. And that's where the buyers take control. And the market can begin recovering. And that can happen at a really fast and furious rate. And that forms the other side of what they call a V-shaped recovery, where it just goes down and goes down really fast, hits that rock bottom, and then bounces up really, really fast. And there's the V's sitting on your trading chart. Although sometimes it can steadily grind higher too. And sometimes it's a combination of both. Now, the bad news is, in these situations, when it's going down fast and furious, there's no telling how far down it can go. And after the bounce, there's no telling how high up the market will move or how fast. But the good news is, it really doesn't matter. In the beginning of the COVID thing in March of 2020, I happened to be largely in cash right before the market fell out of bed. And then, whack. After a little patience, I used a percentage of my cash as margin, and I sold some cash secured puts in SPY. At that time, I used to make daily videos, and I recorded a video sharing what I was doing at that time, and I posted it to YouTube. I'm sure it's still up there. Well, haters are going to hate, aren't they? Yeah. Some internet troll commented on my video that selling puts in a falling market was terrible advice. Why on earth would you do that? Don't you know the market's going to fall more? And I did figure the market was likely to fall more, but I didn't know that. Nobody knew that. Nobody can see the future. And I sure didn't know or have any idea how much more. But as the market continued its rapid decline, well, I sold another tranche of puts. Then, with stocks a little lower, I sold some more puts. And then again, I sold some more until I was what I like to call out of bullets. Or in civilian terms, I had no cash left to use for margin to sell puts. I sold my last put at a level, a strike price, well above where the market hit bottom. All right. I'd love to sit here and tell you I timed it just right, but gosh, I mean, nobody can time it just right. I took assignment on all the puts I sold. And so at the moment, I was down money on those puts, if you looked at it that way. But within a couple of months, the market made back all of its losses, and it just kept climbing and climbing and climbing for long after that. So the strategy worked. The strategy was a long-term strategy. This was not my first trip to the rodeo. I understood why this internet troll was flexing his internet muscles and fracked a rage geyser on my video comment thread. When the market is crashing, people lose their minds. Fear makes them react irrationally. And if you want visual proof of that, just pull up a chart of the S&P 500 for the last 10 years, and there's great proof if you look around March, April of 2020. And if you go out 20 years, you'll see some other examples. Say, geez, why was there that V-shaped bottom there? And just look at what was going on in the news then and say, oh, yeah, boy, the market really overreacted there, didn't they? It happens. Can't say all the time because it's not like every month, but it happens regularly and is going to continue happening regularly. That's just how the market works. And if you look at charts like that, here's what you'll tend to see. As the market begins to fall, implied volatility begins to rise. This is a very common relationship. Generally speaking, implied volatility rises when the market falls about 80% of the time. And the other way around too. Market rises, implied volatility falls about 80% of the time. But here's where it gets interesting. Implied volatility usually peaks just a little before the market's final bottom out. Go ahead and look back at a chart around February to June 2020, and you look for that V-shaped bottom, and you'll see that implied volatility peaked about 5 trading days before the market bottomed out. Why? Well, let's start that story earlier. Why did implied volatility rise? Well, the same reason anything does, right? Supply and demand. There was demand, buying pressure. As the market started falling, some people got nervous and bought options, mostly puts. As it continued falling, some people sold their stocks, but some bought puts. And by the way, when people, us mere mortals, buy puts, the liquidity providers, market makers, are selling puts and hedging by selling or shorting the stock. So even if we're buying puts, that puts downward pressure on the stock market indirectly. People keep buying puts, and you know where they love to buy the most puts? Right before the market bottom. Now, you don't have to know a whole bunch about options to know that the bottom is the wrong time to be buying puts. That's when people do it. I guess it's another one of those behavioral economics heuristics that I like to talk about on a regular basis. Nobody's given it a clever name just yet. I'll have to think about it, come up with it, coin it. What do you do with those? We got any intellectual property lawyers out there? Call me up. But here's the thing, like any of the other psychological heuristics that we talk about, once you understand that that's what humans' brains are wired to do, well, then you don't have to follow it. You can overcome that. Knowledge is power, right? You can lean into the fear, especially when selling puts to acquire long-term investments at now lower prices using the trade objective, meaning wanting to sell the puts to get assigned. Now, you don't know when the market will finally capitulate, but when the market's nearing capitulation, like nearing the bottom, that stomach turning point, well, you know three things. Number one, the market is likely to eventually recover. This may not be true for all individual stocks in situations, like ones that are permanently impacted by whatever the situation that caused this market malady or correction or crash or whatever has done. But over the last century, the stock market has averaged an annual return of 10% on average. Now, that's not guaranteed either. In investing, nothing is. But I'm here to tell you, it is very, very likely that in those situations, the market recovers. If and when it does, the recovery could take a while, like after the dot-com bubble, or it could be quicker, like after COVID. Now, the other thing the second thing is that time will pass. If time doesn't pass, well, you have a whole bunch more to worry about than trading. The third thing is that implied volatility is even more extremely likely to fall from its highs than even the stocks are to rise. We're specifically talking about a capitulation scenario where the implied volatility reaches these nosebleed levels. We call this a spike in implied volatility, where it shoots up and then maybe the next day it kind of comes back down. It might stay a little higher than it was before the spike for a bit, but these are usually like a 1 or 2 day massive move up and then back down. A massive spike in volatility reverting to its mean is how it typically works. That's the norm. And look, hey, again, just for legal purposes, I guess, nobody can guarantee anything in the stock market, but I am a man who will bet on volatility reverting back to its mean after a major spike. So think in terms of the Greeks for those three things, right? Market recovers, time will pass, volatility comes back down. Okay, so after we hit bottom, what do we want? Positive deltas when the market's going back up. We want positive theta as time passes. We want negative vega as implied volatility falls. So if the most likely outcome that has historically always happened eventually comes to fruition, Cash secured puts, they have a lot going on for them. But there are a couple of caveats. The next full on market capitulation, who knows when it's going to happen? Could be 5 years from now, could be 10 years from now. And when it happens, you're not going to get it exactly right. You're not going to necessarily be in all cash at the top and wait and time it and sell puts at the very bottom. It's never going to happen. But it doesn't have to. You just got to do a pretty good job and it can be really profitable. Patience is the key. Investors need to overcome those inherent miswired neurons. It's very difficult for a typical investor to keep a level head when everybody else is buying those overpriced puts because they have this irrational fear. And they're posting on social media, oh my goodness, anybody who sells puts is crazy. You should be buying them. It can get in your head. When we're not sure what to do, we're also wired as humans to do what everyone else is doing. This is a principle called social proof, which I believe that term was coined by Dr. Robert Cialdini. This is just another heuristic, another way our brain works that in turn makes investing a little harder. Capitulation trades, they can be tough, man. They're not for the faint of heart. I'll tell you that. The goal isn't to pick the absolute bottom. The other hard part of capitulation trades is that if you do it, you're basically certain to be down money on the trade for a period of time. And it could be down a lot of money, and it could be a long period of time. The only way to do something like this, that is, again, not for the faint of heart, is to have the right frame of mind and to be only thinking long term. And I'll tell you what, you do that, and that'll help you be fearful when you should be and not fearful when you shouldn't be. And it can be a nice trade. But some humans are just not mentally capable of handling such an emotionally charged situation. It's definitely not for everybody. Another thing about capitulation trades is that in some cases, the market or the individual stock can recover really, really fast and just rip relentlessly higher. When I say V-shaped bottom, I'm talking about a pretty skinny V. Once the puts get assigned and the market's rocketing up, that's not always a good time to wheel back into covered calls. Just like on the way down, which put strikes to sell and when, the timing is impossible to get right with when to sell covered calls and at what strike to. It's inevitable for capitulation traders with freshly assigned shares in their hands to start selling calls early and miss out on some of that upside, or to start selling calls late and miss out on premium opportunities. And that, my friends, is all part of this messy game as well. And that about wraps it up for this show. But before you go, be sure you're getting the most out of Wealth Building with Options and become a paid subscriber. With your paid subscription, you get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show, subscriber-only posts where I'll drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much more. And the best part is Your paid subscription helps keep this show on the air. To become a paid subscriber, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com, and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video series, which alone is valued at more than the subscription, and get a signed copy of my new book, Build Consistent Wealth with Options. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.